There haven't been any news updates on SoFi as far as we know since their Q3 earnings in November. But we've continued to see SoFi stock get pummeled in the market, so we'll talk about whether that is because of reasons specific to SoFi or if it's just a part of the wave of the whole tech sector's market decline in recent weeks. We'll also go over key points made by SoFi's management at the Nasdaq and Morgan Stanley Virtual Investor Conference on November 30th and the Credit Suisse Technology Conference on December 1st. SoFi Sell-Off. Did SoFi do something wrong or is it just a wave? SoFi stock crashed this week. The stock price fell over 18% this past week. But SoFi isn't the only victim of sell-offs this week. Other fintech companies also met its demise. Affirm's stock price fell over 23%, Upstart went down over 20%, and LendingClub also went down 20%. A few things triggered massive sell-offs for fintech companies especially, and the good news is that they are due to macroeconomic reasons and not because SoFi did something wrong. First, the Omicron variant especially hurt the fintech stocks because fintech companies are in the business of making loans. The variant increased fears of more lockdowns, which would hurt the economy, and in turn, this could negatively impact the borrower's ability to pay back loans as well as dry up demand for loans. SoFi's biggest business is loans, so the company saw a big sell-off along with other fintech companies that make loans such as Affirm, Upstart, and LendingClub. Secondly, as we know, continued high inflation has been fearing investors of interest rate hikes, and that became more likely when Federal Reserve Chairman Jerome Powell spoke on December 1st about interest rate hikes becoming more certain in 2022. Higher interest rates means lending companies can charge higher interest on loans, but it also means that consumers may have a harder time paying back, and this could lead to higher loan defaults. Higher interest rates also means that the valuation of future cash flows of companies is worth less, and this has investors and analysts re-evaluating companies' target price. And another macro factor that played a part in the crash was the U.S. November jobs report. According to the report in particular, hiring in leisure and hospitality was sluggish, and retail lost jobs despite the traditional holiday hiring season. 2022 was believed to be a great comeback year for the economy, but this signaled that perhaps people have not quite gotten rid of fears of COVID and its related factors. Some analysts believe that this sell-off and stock crash may be good for fintech companies that have been trading at massively high valuations lately. The fundamentals of these companies have not changed much, and it is mainly macro factors that are adjusting these stock prices. This correction may be necessary at this time so that the prices correctly reflect the company's valuation. We will talk more about what SoFi CFO Chris Lapointe had to say about how the higher interest rate would impact SoFi when he spoke at the Credit Suisse Technology Conference on December 1st. Key points from SoFi's management at the conferences. On November 30th, SoFi's CEO Anthony Noto spoke at the Nasdaq and Morgan Stanley Virtual Investor Conference. On December 2nd, he also spoke at the Wells Fargo Annual Conference. And on December 1st, SoFi's CFO Chris Lapointe spoke at the Credit Suisse Technology Conference. Here are the key points from the CFO Chris Lapointe. SoFi's overall outlook has not changed since IPO. At a high level, by 2025, SoFi is still planning to be a $3.7 billion revenue business with about $1.2 billion of adjusted EBITDA. They expect their lending business to grow by about 25% annually over the next 5 years, driven by home loans business, where SoFi is just getting started. In their technology platform segment, which is primarily Galileo, they expect about 50% annual growth over the next 5 years. And their financial services business of SoFi Money, Invest, Credit Card, and others, they expect this to be the biggest growth of about 150% annually over the next 5 years. They are just starting to scratch the surface and monetize their SoFi Invest products. As mentioned earlier, one of the reasons for SoFi's stock, along with other lending fintech companies getting pummeled this week, was a more certainty of a higher interest rate. But when SoFi's CFO was asked about how the higher interest rate will affect SoFi, he said something very interesting. What they've seen is that in rising interest rate environments, their personal loans business does really well because people are looking to refinance. And in lower interest rate environments, their student loan refinancing and home loan refinancing business does extremely well. So from their experience of navigating the last few years of different interest rate cycles, they have learned to adapt so that they see a netting effect from their various businesses. This enables them to withstand any type of credit and interest rate environments. As we said in our episode 37, SoFi is continuing to diversify their portfolio by adding more products and services so that they can cross-sell to their clients. And as we can see, another positive impact of diversifying their portfolio of products is to be able to withstand macro market cycles. Lapointe also talked about the highly anticipated bank charter and gave a positive indication. He said that over the course of the last year, they have been going through field exams with both the OCC and the Fed, and things have progressed really nicely. He also added that they've had a great dialogue with both the Fed and the OCC and are optimistic. If SoFi wasn't sure about the bank charter, management would be very careful of what they say, so the fact that the CFO said they are optimistic is a good sign. Throughout the interview, Lapointe mentioned other opportunities which we can look forward to in terms of SoFi's growth. The key theme is that they are adding new products to their portfolio to make additional revenue sources and bundling their existing products to increase cross-selling and upselling. For instance, SoFi's crypto trading platform is one of 5 ways SoFi Invest's business makes money. As the crypto space becomes more mainstream, SoFi will benefit from this platform. SoFi will also be rolling out options in margins, which will be additional revenue source for that business. They're continuing to offer product bundles to their users in order to increase revenue per share with cross-selling. For example, they rolled out a SoFi Money and Personal Loans bundle, which gave people discounts on their loans for taking out the SoFi Money product and direct deposit, and that drove significant demand for both products. And Lapointe said that we can expect to see more bundling. On the other hand, Anthony Noto's talking points during his interview at the 2 conferences were more about the high-level vision for the company. Unlike Lapointe, Noto didn't mention anything about the progress of the bank charter, but he focused a lot on the growth of SoFi's core business. This seemed to indicate that the bank charter is something that will certainly add value to the company, but it is not what is going to drive the business growth. In other words, his vision for SoFi is grand even without the bank charter. Here are the key points about the growth opportunities for SoFi that Noto said. Currently, the company is going after a higher-end demographic that has a $100,000 household income or more. There is still a lot of market share to grab, and over time, they will expand their demographic beyond that. SoFi is building defense around their products against their competitors in 2 ways. First, they are holistically offering a diverse portfolio of products so that customers don't have to fill out a new form for a new product, but instead, they can perform all their financial needs in one place with ease. Second, within each product, each of SoFi's product team and managers have the responsibility of differentiating each product against their direct competitors. From their approximately 3 million members, SoFi will continue their marketing campaign efforts to drive member growth to their goal of 10 million members in 5 years. When asked about acceleration of growth on a sequential basis, Noto corrected the interviewer that SoFi will see year-over-year growth. If we're speculating on wordplay, this could imply that the Q4 earnings report may still show continued year-over-year growth and still a good growth quarter-over-quarter, but perhaps we won't see higher acceleration of quarter-over-quarter growth. As a one-stop shop, SoFi still has more opportunity of new products that they can introduce and offer to clients. For example, they're not in tax yet. They're not in auto insurance or auto loan refinancing. They will continue to add more products over time incrementally. Analyst Consensus. As we approach a confirmed higher interest rate in 2022, we may see analysts re-rating SoFi stock as they re-evaluate the company's valuation. For now, however, the average analyst consensus target price is around $25, and the stock still has an outperform rating. In conclusion, the major decline in SoFi stock is due to macro factors, and it is affecting fintech companies especially. But the fundamentals haven't changed. SoFi's CEO and CFO explained that they have diversified their portfolio of products to a point where, when market conditions like interest rates change, the net impact of the business is neutral because of the positive and negative effects on their different products. Member growth, cross-selling, addition of new products, and reiterating on their existing products to become more differentiated from their competitors are all factors that will contribute to their 5-year growth plan.